Have you ever felt your heart racing, palms sweating, watching a stock soar higher and higher while you sit frozen on the sidelines? That voice in your head screaming, "Get in now before it's too late." That paralyzing fear of missing out, that sickening sensation in your gut telling you the train is leaving the station without you aboard. Has this ever happened to you? If you've experienced this even once in your trading career, then what you're about to discover in this video might fundamentally change how you approach the markets forever. The irony is almost cruel. The exact moment when your entire being is screaming at you to act is precisely the moment when action becomes your worst enemy. That urgent impulse to chase price, to jump into a trade that's already moving away from you, feels like opportunity knocking at your door. But here's the brutal truth most traders learn only after emptying their accounts. That feeling isn't opportunity. It's the market's siren call, luring you toward the rocks where countless trading accounts have been shattered beyond repair. Think about your last impulsive trade for a moment. That entry you took because you simply couldn't stand watching anymore. You knew your plan said to wait. You knew the setup wasn't quite right, but the price kept climbing, and that gnawing anxiety became unbearable. So you clicked the buy button. But before we begin, please hit the like button and let me know where in the world you're watching from today. It's always fascinating seeing who's joining us from around the world, and if you haven't already, make sure to hit that subscribe button and turn on the notification bell so you don't miss any of our future videos. Now, back to that trade you took out of pure panic. How did it feel the moment after you entered? Let me guess. Instead of the relief you expected, a different kind of anxiety immediately took hold. Your position was already underwater, or so close to your mental stop loss that every minor price fluctuation felt like a knife twisting in your gut. You found yourself glued to the screen, unable to look away, your stress levels skyrocketing with each passing minute. This isn't trading, this is torture. And the devastating part is that this single impulsive decision didn't just cost you money, it cost you something far more valuable. Your mental capital, your discipline, your confidence in your own system. What most traders don't realize until it's too late is that chasing entries creates an insidious trifecta of destruction that virtually guarantees failure. Stay with me until the end of this video, because understanding this mechanism is the difference between consistent profitability and perpetual struggle. When you chase price, you're not just making a bad entry, you're fundamentally compromising every single aspect of your trade structure. Your position sizing becomes arbitrary because you're buying at the wrong price. Your stop-loss placement becomes either impossibly wide or dangerously tight, and your psychology becomes toxic from the very first second you hold the position. The question isn't whether chasing entries is bad for your trading. That's already established. The real question is, why do we keep doing it? What is it about human psychology that makes this self-destructive behavior so compelling, so irresistible, even when we intellectually know better? And more importantly, what's the alternative? How do successful traders actually approach entries in a way that eliminates stress, protects capital, and creates structural advantages from the very beginning? The answers to these questions reveal a completely different way of thinking about market timing, one that transforms trading from an anxiety-inducing battle into a patient, methodical practice. The transformation begins with a single radical realization that flips everything you thought you knew about trading completely upside down. Most people enter this world believing that success comes from constant action, from being always engaged, always analyzing, always ready to pounce on the next opportunity. It's an intoxicating mindset because it makes you feel productive, important, like a warrior in the trenches of financial markets. But here's the hidden truth that separates professionals from perpetual strugglers. The real work of trading isn't done during execution, it's done during the waiting. Think about what actually occupies your time as a trader. If you're honest with yourself, how much of your day is spent genuinely executing high-probability setups versus how much is spent watching, analyzing, second-guessing, and ultimately forcing trades that your system never actually signaled? The mathematics of professional speculation reveals something that seems almost absurd at first glance. Trading is roughly 90% waiting and maybe 10% actual execution. Your mind probably resists this ratio because it feels counterintuitive, unproductive, even lazy. We've been conditioned by society to equate activity with value, movement with progress. But in trading, this conditioning becomes your greatest liability. If this resonates with you, subscribe to the channel. I'm building a community focused on trading psychology and real discipline. The professionals who consistently extract wealth from markets aren't doing more than you. They're doing dramatically less. Their edge isn't found in some secret indicator or proprietary information. Their advantage is something far more powerful and infinitely more difficult to cultivate. The ability to sit on their hands for days, weeks, sometimes even months, preserving their capital and mental energy until the market delivers exactly what their system demands. This requires a complete rewiring of your relationship with action itself. You must embrace stillness not as weakness, but as strength, not as missed opportunity, but as strategic positioning. Now, I want to go even deeper into this concept because understanding it intellectually is one thing. Embodying it is something else entirely. When you're genuinely waiting with discipline and purpose, you're accomplishing something profound that operates on two simultaneous levels. First, you're protecting your financial capital by refusing to expose it to mediocre setups that carry unfavorable risk-reward ratios. Every trade you don't take is capital preserved for the trade that actually matters. But second, and perhaps even more crucial, you're conserving something most traders never even consider: your mental and emotional capital. The market has an almost vampiric ability to drain impulsive traders of psychological energy, extracting not just dollars, but decision-making capacity, clarity of thought, and emotional stability through the constant worry that comes with managing poorly conceived positions. The professional trader understands that his nervous system, his attention, his ability to maintain composure under pressure, these are finite resources that must be managed as carefully as money. He sits and watches, studying patterns, waiting for his specific criteria to align, conserving his nerve and firepower for that singular moment when conviction meets opportunity. He doesn't gamble on every spin of the market's roulette wheel. He waits for the handful of times per year when the house edge disappears and the odds genuinely favor his side of the bet. This journey, from compulsive action to disciplined patience, represents nothing less than a complete transformation of your trader identity, a fundamental shift in how you measure success and define your role in the marketplace. Write in the comments, "Patience is my edge," if this resonates with your own trading journey. The revelation that changes everything is this: successful trading isn't about reacting to what the market is doing right now. It's about deciding in advance what the market must do to earn your capital. This represents a fundamental power shift, a complete reversal of the typical trader's relationship with price action. Most traders wake up, open their charts, and let the market dictate their decisions. They're reactive, scanning for opportunities, looking for something that feels right in the moment. But this approach surrenders all control to the chaos of real-time price movement, leaving you vulnerable to every emotional impulse that arises when money is on the line. The professional operates from an entirely different framework, one built on premeditation rather than improvisation. Before the market even opens, before a single candle prints on the chart, he has already done his most important work. He has identified his levels with precision, specific price points derived from careful observation of resistance lines, previous breakout zones, areas where major reversals occurred. These aren't arbitrary numbers plucked from thin air. They're coordinates on the battlefield where probabilities shift meaningfully in his favor. Everything else, all the noise between these critical levels, becomes completely irrelevant to his decision-making process. This is where the hidden truth behind consistent profitability reveals itself. When you define your optimal entry zone in advance, you create an objective filter that protects you from your own psychology. Price can dance, spike, plunge, create dramatic candlesticks that trigger every fear and greed receptor in your brain. None of it matters if the price hasn't reached your predetermined level. You've essentially drawn a line in the sand and made a commitment. This is the price I deserve, the price where risk and reward align with my system, and I will not compromise this standard regardless of what emotions the market attempts to evoke. But here's where most traders stumble, even after understanding this concept intellectually. They set their level, they know where they want to enter, and then the market starts moving. The stock that they wanted to buy at $50 suddenly jumps to 51, then 52, then 53, and that old familiar panic begins creeping back in. The internal dialogue shifts from discipline to desperation. Maybe I was too conservative with my level. Maybe I should adjust. If I don't get in now, I'll miss the entire move. This is the precise moment where your transformation as a trader either solidifies or crumbles. If this clicked for you, tap that like button. It helps this message reach other traders who need it. The truth demands absolute clarity here. If your level was $50 and the price never touched $50, then that trade never existed. Period. You must develop the mental fortitude to treat it as if the market never opened that day. The price must come to your level. You never, under any circumstances, rush to meet the price. When you chase that run-up from 51 to 53, you're not just paying a few extra dollars per share. You're making a declaration that your desire to participate, your fear of missing out, your need to be in the action outweighs your discipline to secure the proper risk profile. You're conceding your analytical edge before the trade even begins. This decision, this moment of either holding firm or capitulating to impulse, reveals everything about your trading maturity. The market will test your resolve constantly, offering you trades that are almost right, setups that are close enough, prices that are only slightly above your predetermined level. These tests are not accidents. They're the mechanism through which the market separates disciplined capital from desperate capital. Leave a comment saying, "Price comes to me," if you're committed to this principle. The impact of a chased entry extends far beyond the initial moment of execution. It infects every single second you hold that position, poisoning your trading psychology in ways most traders don't even recognize, until the damage is already done. When you buy too high or sell too low because you couldn't wait for your predetermined level, you're not just accepting a suboptimal price. You're fundamentally compromising the structural integrity of your entire trade architecture. Your position begins its life underwater or perilously close to where your stop-loss must logically sit, which means you've already lost before the market even has a chance to move in your favor. This structural compromise creates what I call toxic mental margin, a psychological burden that colors every decision you make from that point forward. Instead of calmly managing a position that has room to breathe, you're immediately thrust into defensive mode, spending your mental energy trying to justify and protect a poorly initiated trade. You watch every tick, feeling your stomach tighten with each minor fluctuation against you. Your attention becomes consumed not by profit potential, but by the growing fear that you'll be stopped out at a loss simply because you didn't have the patience to wait for the right price. This is exhausting, unsustainable, and utterly unnecessary. The hidden truth behind comfortable trading lies in understanding that the quality of your entry determines the quality of your entire trading experience. When you allow the price to come to you, when you exercise the discipline to wait for your optimal entry zone, something remarkable happens. Your transaction becomes clean. Your risk is precisely defined from the very first moment. Your stop-loss sits at a logical location where the market structure would genuinely be invalidated, not some arbitrary panic point squeezed in to make the position size work. This creates a structural advantage that manifests as psychological peace. Think about the difference in these two scenarios. In the first, you chased the entry, bought near the top of a surge, and now every small retracement feels like the beginning of a collapse. You're glued to your screen, anxiety building, second-guessing your decision, debating whether to cut the loss or give it more room. In the second scenario, you waited patiently. The price came down to your predetermined level. You entered with conviction at a point of structural value, and now the position has space to develop. The market can oscillate naturally, pulling back and pushing forward, without triggering your emotional alarms. You check the position occasionally, but you're not imprisoned by it. Because your entry was based on analysis, not desperation. This journey from uncomfortable to comfortable trading isn't about finding some magical indicator or secret technique. It's about mastering the relationship between patience and position quality. An uncomfortable entry will always produce an uncomfortable trade, regardless of whether it ultimately becomes profitable. You'll have suffered through stress, lost sleep, made emotional decisions, and even if you squeak out a win, you've paid an enormous psychological toll. But a comfortable trade, one that respects structural value and proper entry protocol, requires almost no maintenance. You set it, monitor it according to your plan, and let the market do its work while you preserve your mental clarity for the next high-probability opportunity. The transformation happens when you realize that your goal isn't simply to make money. It's to make money easily, with minimal psychological friction, in a way that's sustainable over decades rather than weeks. The difference between grinding, anxious profits and smooth, calm profits often comes down to nothing more than a few ticks of patience, that willingness to let the market come to your price rather than desperately chasing after it. Drop a comment with "clean entry, clear mind" if this perspective is reshaping how you think about trade execution. The revelation becomes even more striking when you examine what chasing does to the very foundation of intelligent speculation, risk management. This is where the illusion completely shatters, where you see behind the scenes of why so many traders fail despite understanding charts and patterns. When you rush into a position far from the logical starting point of a move, you immediately face an impossible dilemma that has no good solution. You're trapped between two equally destructive choices, and either path leads to the same destination: consistent losses. Consider the mechanics of this trap. Your stop loss must be placed where your analysis is proven wrong, where the structure you identified actually fails. But if you bought at $53 when your analysis suggested entering at $50 and the logical invalidation point sits at $49, you're now staring at a $4 risk instead of the $1 risk your system was designed around. This forces you to slash your position size dramatically just to maintain proper risk per trade, which completely destroys your reward-to-risk ratio, even if the trade works. You're risking the same dollar amount, but with far fewer shares, meaning your profit potential has been decimated by impatience. The alternative seems tempting, but proves even more catastrophic. You could tighten that stop arbitrarily, placing it at $52 or $51 to keep your position size intact, but now your stop exists within the realm of normal market noise. You're no longer protected by structural analysis. You're gambling that random price oscillation won't trigger your exit before the real move develops. And it will trigger, almost every time. You'll watch yourself get stopped out by meaningless fluctuation, only to see the market reverse and continue in your originally anticipated direction, now without you aboard. This cycle of arbitrary stops and premature liquidations creates a psychological wound that compounds with each repetition. The deeper journey here involves recognizing that fortunes in speculation aren't built through constant engagement with every market wiggle. This mindset shift challenges everything our action-oriented culture teaches us, but the evidence is undeniable. The traders who accumulate serious wealth over time aren't the ones making 20 trades per week. They're the patient hunters who sit motionless for extended periods, waiting for those undeniable massive moves that define entire trends. The market might offer a dozen genuinely high-probability, structurally sound opportunities per year where all factors align perfectly. Your singular task is conserving your ammunition, financial and psychological, for precisely those moments. The perpetual trader operates under a completely different paradigm, one driven by addiction to action rather than dedication to profit. He depletes his capital through the relentless accumulation of commissions and small losses on mediocre setups. He exhausts his emotional reserves through the constant anxiety of monitoring multiple marginal positions simultaneously. Perhaps most damaging, he consumes all his mental bandwidth managing trades that never had strong conviction behind them, leaving nothing in reserve when that career-defining opportunity finally presents itself. He's shooting at shadows when he should be loading his rifle for elephants. This transformation in how you allocate your attention and capital represents perhaps the most difficult evolution in your trading journey, because it requires you to embrace what feels like inaction. You must learn to measure your success not by how many trades you executed this week, but by how many poor trades you successfully avoided. Every marginal setup you pass on is ammunition preserved for the setup that actually matters. The one that appears maybe once per month, where everything aligns so perfectly that success feels almost inevitable. Write quality over quantity in the comments if you're ready to shift from activity to selectivity. The distinction that separates amateurs from professionals exists not in their technical knowledge or chart-reading ability, but in how they fundamentally relate to market movement. When you chase an entry, you're engaging in an act of prediction. You see price moving sharply upward, your pulse quickens, and your mind immediately leaps forward, constructing a narrative about where this momentum will carry the stock. You're speculating based on hope, on the assumption that what's happening right now will continue happening. This predictive mindset places you in the dangerous position of betting on an imagined future rather than responding to confirmed present reality. The professional operates from an entirely different framework, one built on confirmation rather than anticipation. He doesn't predict that price will do anything. Instead, he identifies his critical level in advance, then waits for the market to actually arrive at that level and demonstrate its intentions through price action. He's looking for evidence. Volume patterns, rejection candles, support holding, whatever his system defines as proof that the original analysis remains valid at the moment of execution. This confirmation-based approach means he's entering on facts, on demonstrated market behavior, not on excitement or hopeful projection about what might happen next. The hidden truth here cuts deep. The market will always offer you its terms, which are designed to extract maximum capital from maximum participants. When you chase, you're accepting the market's terms, buying on its timeline, at its price driven by its manufactured urgency. But when you wait for confirmation at your predetermined level, you're imposing your terms on the market. You're stating clearly, I will participate only when you meet my conditions, when you provide the evidence I require. This power dynamic shift represents nothing less than a complete transformation in your relationship with speculation itself. Now, beyond the immediate monetary consequences of chasing entries lies something far more insidious and long-lasting, the psychological penalty that compounds over time. Every impulsive action that ends in failure extracts a toll that exceeds the dollar amount you lost. You're paying an emotional tax, accumulating psychological debt that will come due when you least expect it. Each time you chase, get burned, watch your stop get hit, and suffer that sickening feeling of being liquidated, you're embedding a pattern of failure deep into your neural pathways. This pattern doesn't simply disappear when you close the position and move on. The impact manifests most cruelly when genuine opportunity finally appears. That perfect setup you've been waiting for materializes. Price hits your exact level, confirmation signals flash, everything aligns precisely with your system. But instead of executing with confidence, you hesitate. That accumulated psychological damage from previous chased entries whispers doubt into your consciousness. What if this one fails too? What if you're wrong again? Remember how painful the last loss felt. This hesitation, this crippling fear born from past impatience, causes you to miss the very opportunity that your discipline was supposed to capture. Your level of trading stress serves as a precise diagnostic tool, revealing the state of your internal discipline. If you find yourself constantly anxious, checking positions obsessively, unable to focus on anything else, this stress is directly measuring your impatience. You're forcing trades that your system never signaled, pressing the market to give you something it hasn't offered, sacrificing your internal peace for the illusion of productivity. The journey toward consistent profitability requires recognizing that this stress isn't an unfortunate side effect of trading. It's a symptom of violating your own principles. Leave evidence over emotion in the comments if this distinction is becoming clear to you. The most liberating yet simultaneously humbling realization you'll ever have as a trader is this: the market is entirely, profoundly indifferent to your existence. It doesn't care that you missed yesterday's explosive move and feel desperate to catch today's action. It doesn't care that you need to make money this week to pay bills or validate your ego. It doesn't care about your emotional state, your financial requirements, your carefully constructed narratives about what should happen next. The market moves according to the collective actions of millions of participants, institutional flows, algorithmic execution, and forces far beyond your individual needs or desires. Understanding this indifference isn't depressing, it's the gateway to freedom. This revelation demands a complete decoupling of your personal circumstances from market timing. Too many traders unconsciously operate as if the market exists to serve them, as if it should provide opportunities on their schedule, aligned with their emotional readiness or financial desperation. When you need action, when you feel that burning requirement to do something today, you're importing your personal agenda into an environment that operates by entirely different rules. This confusion between what you need and what the market is offering creates the perfect conditions for catastrophic decisions. The hidden truth about professional trading is that it has nothing to do with constant engagement. The amateur confuses activity with productivity, believing that his value as a trader is measured by how busy he appears, how many charts he analyzes, how frequently he enters positions. But the professional understands that his singular job is securing profit, period. If securing profit requires sitting motionless for 3 weeks while markets chop sideways in indecision, then sitting motionless is the work. If profit opportunities aren't present according to his defined criteria, then there is literally no work to be done. And attempting to create work where none exists is simply destroying capital to satisfy psychological discomfort. The transformation into this mindset requires building an unshakable foundation, and that foundation is constructed through the practice of premeditation. The real speculator, the one who consistently extracts wealth over years and decades, does his most vital work before the market ever opens. He sits in the quiet hours, away from the chaos of live price action, and defines everything. With surgical precision, his buy levels are predetermined, his sell levels are marked, the exact price where his analysis would be proven false is identified, his profit targets are established. This comprehensive planning creates an ironclad framework that protects him from his own impulses when emotion runs high. When you engage in true premeditation, you're building the only reliable defense against the seductive urge to chase. You've drawn your battlefield map before the war begins, identified where you'll engage and where you'll retreat, established the conditions that warrant action versus the conditions that demand patience. Once this plan exists, something remarkable happens to your perception of price movement. Any action that occurs before the market reaches your designated entry price becomes instantly reclassified as irrelevant noise. It's not opportunity, it's distraction, specifically designed by the market's natural volatility to hijack weak emotional traders who lack the anchor of a predetermined plan. This practice shifts your entire relationship with real-time trading from reactive to strategic. You're no longer at the mercy of what the market shows you minute by minute. You're operating from a position of strength, executing a campaign that was designed when your mind was clear, calm, and free from the corrupting influence of live profit and loss fluctuations. The journey to this level of discipline separates those who survive in markets from those who thrive across decades. Type plan first, execute second if you're committed to this practice of premeditation. The deeper you journey into understanding patient speculation, the more you realize that time itself functions as perhaps your most powerful analytical tool. Time isn't simply a measure of how long you've been waiting. It's the ultimate filter that separates genuine high-probability setups from manipulative noise designed to trap emotional capital. When price approaches a critical level with violent speed, surging upward or plunging downward in a matter of minutes before immediately reversing, you're often witnessing nothing more than a temporary imbalance, a short squeeze or deliberate manipulation by participants with short-term agendas. These rapid movements feel significant in the moment, triggering every instinct to act, but they lack the structural validity that breeds confidence. A true, high-conviction entry opportunity requires time to develop at your predetermined level. The market needs to arrive at that critical price point and then do something revealing. Test it, consolidate beneath or above it, absorb supply or demand, prove through sustained action that large operators with serious capital are genuinely interested at this level. This process cannot be rushed. When price spends hours or even days building a foundation at your level, when you see repeated tests that hold, when volume patterns confirm accumulation or distribution, you're witnessing the market validate your analysis in real time. Time allows the big players, the institutional money that actually moves markets, to reveal their intentions through their footprints. The transformation in your trading comes when you stop fearing moves that develop slowly and start fearing moves that happen too quickly. Speed without structure is danger. Time with consolidation is confirmation. The patient speculator understands that if a level is truly significant, the market will respect it long enough for him to execute his plan. If the market touches a price and instantly recoils, that information tells you the level wasn't as important as you thought, and you've just been saved from a poor trade by your discipline in waiting for time-based confirmation. This brings us to what might be the most challenging yet rewarding aspect of this entire journey: mastering the art of stillness. The critical difference separating amateurs from professionals isn't found in intelligence, technical knowledge, or sophisticated charting abilities. It's found in something far more fundamental and far more difficult to cultivate: profound bedrock patience that borders on stubbornness. You must stop begging the market for entry opportunities. You must stop forcing your way into positions simply because you feel the need to be engaged. Your actual task, the work that will determine whether you succeed or fail over the long term, is finding perhaps 1 or 2 movements per month that offer genuinely clean structural advantages where all factors align in your favor. That gnawing discomfort you feel while sitting on your hands, that tension building in your chest as you watch price move without you, that fear whispering that you're missing out on riches, these sensations aren't signs of inefficiency or weakness. They're the precise feeling of professional discipline actively working to protect your capital. This discomfort is you being paid to wait, paid to preserve. Your ammunition for the moment that truly matters. Most traders never develop the capacity to sit with this discomfort. They interpret stillness as failure, inaction as lost opportunity, and they rush back into the market to relieve the psychological tension, sacrificing capital to ease emotional distress. Drop "stillness is strength" in the comments if you're embracing this uncomfortable but essential transformation. The path forward from here is yours to walk, but you don't have to walk it alone. If what we've explored together in this video resonates with you, if you're genuinely committed to this transformation from reactive trading to disciplined speculation, then I want to invite you to subscribe to this channel. This isn't just another trading channel throwing indicators and hot tips at you. This is a space dedicated to the psychology, the discipline, the mindset shifts that actually separate consistent winners from perpetual strugglers. The content here is designed to rewire how you think about markets. And if today's message landed for you, there's much more waiting that will continue pushing your understanding deeper. Leave a comment right now saying, "I stayed until the end, so I know you're serious about this journey." When I see those comments, it tells me you're not just passively consuming content, you're actively engaged in your own development as a trader. That matters to me, and it should matter to you too, because transformation requires commitment, not casual interest. And if this video shifted something in your perspective, if you found yourself nodding along, recognizing your own struggles in what we discussed, hit that like button. It's a simple gesture, but it helps this message reach other traders who desperately need to hear it. People who are right now bleeding capital because they're chasing entries out of fear and impatience. Before you go, there's another video I've prepared that takes this conversation even further. It dives into the specific psychological patterns that sabotage your trading and the practical frameworks you can use to build unshakable discipline. Click on it and continue with me there. You've already invested this time in understanding the problem. Now let's keep building the solution together.